We thought of getting you a very special discussion today on an argument which happens in the market very often while discussions. What is the market capitalization? Are you bullish on mid caps? Are you bullish on small caps? These are the kind of questions we keep asking ourselves and our friends, be it the fund management industry or generally. So we thought of talking about are we paying too much attention on the market cap of the company while discussing what the future holds for the company or the stock, and perhaps we do not give much attention to the most important essential aspect of stock performance, and that is earnings, the profit pool, the growth which lies ahead. That's the topic of discussion we have planned with Rajesh Kothari of AlfAccurate Advisors. It's one of the best performing PMSs right now. Rajesh, thank you so much for joining us. What are your thoughts as you were discussing offline as well? Do you think market often pays less attention to profit pools and outlook on growth of those profit pools compared to what the size of the company is? What is your understanding of that matter?
Well, you are absolutely right. So from the investors' perspective, they always, at times they believe that just because a company is large cap, company will do reasonably well. I will lose less money. So it is basically provides a very safety net. And even if I make 7, 8, 9% returns, even if I can outperform benchmark by 2-3%, I'm fine with it. But reality is actually completely different. An investment approach based on just market cap, I think it's going to be a suicidal kind of an approach, because in reality, there are a number of companies. In fact, if you do 10-year study, almost 40 to 45% of BSE 100 companies have reported negative returns despite investors holding for 10 years. And that's a very big number. I'm talking about roughly 45% of entire BSE 100 universe, which if you bought in 2009 and if you're holding for 10 years, 2020, they are still negative, they are underwater. So investment just based on large cap, market cap, I don't think that's the right rule if you want to create value.
Rajesh, let's look at the universe we are talking about. There are various factors each of the companies, irrespective of the size, are applying on the business models and hence trying to ensure that the profit pool improves and going ahead. But what universe are we talking about? You're of course running your outfit now at AlfAccurate, but have been working in funds also previously. How's the investment universe looking, where profits are very healthy and hence the stock picking around that is likely to be higher?
A very interesting question, Ajay. So if you look at India, roughly about 5,000 plus companies are listed in Indian bourses. Out of that 5,000 companies, roughly 1,200 companies are making net profit 10 crores and above. Only 1,200 companies. It means roughly about 22% of the universe, they make net profit just 10 crores. I'm talking about $1.5 million to be precise. And of that 1,250, there are only 540 companies which makes profit in excess of 100 crores. So the entire universe, although it looks very big, 5,000 plus companies, only about 10 to 11% of the universe makes critical net profit benchmark, that what at least we considered internally from our investment perspective. They basically meet the criteria of 100 crores plus reported net profit. And to us, any company, irrespective of its market cap, if the company reports 100 crores plus profit, to us it is a large company, because it is only 10% of the universe, correct? And we focus on these companies, roughly about 500 to 600 companies which meets this benchmark. Because please remember, to make 100 crores of profit, you require 1,200 to 2,000 crores of revenue. And that is definitely not an easy, benchmark for any entrepreneur or corporate to meet. So I think that's kind of rule of thumb, what we use while making investments.
Right. Rajesh, how should investors go about, or what kind of methodologies do you deploy to find how companies' profit trajectory is likely to improve? Well, of course, it depends on various factors, but some of the factors are most essential ones which you deploy to find, and why it is important once the company crosses the 100 crore threshold or level for profitability. Does the growth comes relatively faster? Talk to us about the dynamics at play.
Ajay, what happens is that when a company crosses 100 crores plus profit mark, its ability to withstand the shocks of the economy, it increases dramatically. The resilience of the business model to face any economic slowdown, pandemic slowdown, money market crisis slowdown, NBFC crisis slowdown, general sectoral downtrend, change in regulations, change in currency, change in US market outlook in terms of the economy demand I'm talking about. The resilience of the business model increases significantly. And that is something very, very important for wealth creation in the long term. Because during the journey of wealth creation, definitely every day is not going to be a good day from the company perspective. There are going to be bad days for the economy and bad days for the sector. If the profit of the company is very small, then the impact on that particular corporate, it will be huge. And many companies probably will not be able to survive those challenges. So of course, there are number of parameters, right business, right management, right governance, right balance sheet. But since right now, you are talking about a market cap versus net profit, I'm trying to give more insights into that. And surprisingly, if you look at those 500 companies which makes 100 crores plus profit, the large cap proportion of that is only 18%. I'm going by the market cap definition of the regulator. And the balance everything, 25% is mid cap and 58% is small cap. So there are investors, they say that, I don't want to be into X market cap because it is a risky, but it has nothing to do with market cap. It has to do with the company. If the company makes profit with a good governance, with good ROE, with good earnings growth, and that is something very critical. Earnings growth is something very, very critical. And we have seen across large cap, mid cap, small cap, if the company compounds the earnings by 10, 15, 20%, then market cap is always mirror of earnings growth in the long term.
Sure. Rajesh, when market starts getting a sense of high profit growth in a company, which may be due to some amount of display of that earnings growth, say in the first few quarters, the challenge of a professional money manager or an investor could be that the street starts assigning same kind of multiples, assuming that this profit growth will continue for the next couple of quarters or even years as well, and hence that profit growth starts getting factored in early. How do one cope with this kind of a challenge, especially the kind of phase of the market we are entering now? There are so many examples, some of them from the pharma API space, some others. The moment market comes to know a wind of it, that the earnings growth are likely to continue at a steady or a high growth phase, all that gets factored in right now. So how does one face that challenge?
Well, I think, and that's where our business cycle approach comes handy. So you have to always look at that what phase of cycle the sector and that company in that particular sector is right now in. Now let's assume, for example, the automobile industry. From last 5 years, the industry has not done anything meaningful in terms of the growth. Whether you look at two-wheeler industry, whether you look at passenger car industry, whether you look at commercial vehicle industry, last 3.5 to 4.5 years, due to one or other reasons, the growth has been very, very subdued. And therefore, now the industry is going to report reasonably good number. Now it is very difficult for any investor to forecast, will it be 10% growth or 18% growth or 20% growth? But you, of course, keep tracking the incremental data points and you need to further build upon your thesis. But that's how one need to take. You need to take the sector cycle approach. You need to take the growth demand drivers. And if those demand drivers, they remain intact, then the growth will continue. Instead of 35% growth in first half, it may come down to say 18% growth, but still 18% is a very, very strong number. Because mind you, the fixed income market gives you 3.7% risk-free rate of return. So any number in terms of the earnings growth higher than 10, 12% over a period of 3 to 5 years is something is always what one should keep looking at from the stock selection perspective.
All right, Rajesh, one last word on which other themes you are following in your portfolios where you think 15 to 18% kind of earnings growth lies ahead over the next 3 to 5 year period. If you could leave us with some thoughts on those lines.
So we remain very positive on specialty chemical space. We are bullish on pharmaceutical space. Clinical healthcare is one interesting segment, I think, which is going to do extremely well. Maybe more than probably 15-18%. It can even cross 20% compounded earnings growth. Automobile cycle, I think, is going to be in your favor over next 2.5 to 4 years, and therefore here again you will see very strong earnings growth. Apart from normal consumer and private banking space, which is always there, the good top three sector, the banks in the country, they will keep growing in line with the economy with 2-3% better because of the gaining market share. So these are the basically sectors and themes on which we are basically positive and we are holding in our portfolio.
Right. All right, Rajesh, we'll let you go on that one. Thanks so much for joining us. And with your perspective, I'm sure our viewers would have enjoyed this very differentiated chat today. That was Rajesh Kothari of AlfAccurate talking about the importance of profit pool and growth compared to the market cap of the company.